Hello, Arizona. Welcome to the Lawgitimate podcast. We are your hosts, Mike and Rochelle Poulton. We're here today to discuss mortgage lending in 2021. Today's show is brought to you by Realty Executives, the AZ Own It team. That's us. We do residential and commercial real estate here in the Valley, sales and consulting. Feel free to get in touch with us. You can find us online at azownit.com or give us a call at 480 400 1297. Now, our guest here today is Juli J. Doyle with Fairway Independent Mortgage. She's a friend of ours from a long time ago, and we're just bringing her on the show today to help fill everybody in about the state of mortgage lending in 2021. Real estate market's been very interesting, and we're looking forward to learning about how that's been affecting mortgages and how mortgages can work for you to help your real estate dreams come true. So, Juli, why don't you introduce yourself and tell us what you do?
Oh, thanks, Mike and Rochelle. I appreciate you having me on. My name is Juli J. Doyle. I've been with Fairway Independent Mortgage for 10 years, been in the industry for over 20. And my passion is really just helping people with their largest asset and usually their largest liability, their home. And really financially looking at that as part of the piece of your financial house, literally. So that's my goal, is to make sure everybody is set up for a good, solid life of security, and that nobody's concerned over the roof over their head.
Excellent. This has been an interesting time in real estate since the pandemic. Obviously, asset values have gone up tremendously. There's been a lot of concern about whether there's a bubble, whether we're going to see a crash, something like happened in 2008 through 2012. What are your thoughts on that? It's something we've discussed on this show in the past, and interested to hear the thoughts of another professional in a different part of the industry.
Right. So what I can tell you is that there's all sorts of factors in play, that there's no way, I'm going to say 99%, that we would have a crash, right? What's so different than 2008 than now is the economy. So we came into the pandemic with a really strong economy, right? But we came in with something that has nothing to do with the economy. We came in with a population called the millennials, right? And so those millennials are at an age, the average age of a millennial right now is 33. And most people buy their first home between 29 and 33, right? So we have this huge population that wants to buy their first home. What does that mean? Well, that means that they have a home to take off the market. It's simple supply and demand, but they don't have a home to give the market. So someone like myself, who was already a homeowner and not quite a millennial, if I was to sell, I typically have a home to give the market and a home to take, right? Even supply and demand. But you have 33% of the population that doesn't have a home to give the market, right? They only are taking from the market. So simple supply and demand with birth rates will tell us that this is going to continue for at least another 3 years. And then you throw in these extremely low interest rates, where you have somebody who, at a higher interest rate couldn't afford a $500,000 house, but at, a 3% rate, my gosh, they can afford a $500,000 home, right? So you just have this perfect storm. And then we have this economy that, as we came into, was really strong. So 2008 had none of those factors. We didn't have the millennials buying. They were still, in high school or in college, living with mom and dad, right? We didn't have that population factor. We didn't have a strong economy. And then what happened between 2008 and 2013 was the builders quit building. So our supply and demand is incredible, right? And as of 2 months ago, the builders were selling homes at 200 in, let's say, Maricopa County, right? The hotbed of real estate activity, not only in Arizona, but for the country, right? Is that the builders were selling 200 homes a month, but they could only complete 100 homes a month. What does that tell you for longevity of this market, right? So it's kind of funny. We've seen people go, oh, I want to go the new build route. And then they get into the new build, and their new builds are taking a year and a half to complete. And they're like, nope, let me go back to the retail, right? Where I know I can, if I get in contract, I can close in 30, 45 days, or, sometimes 21 days, right? So that's really we have two completely different markets. So it's almost impossible. That's why I'm going to say 99% that we can't have a boom. What I do see happening is in that 3-year mark, as interest rates go up a little bit, right? Then, we get into the fours, scary, is that we'll see appreciation slow. And we're just starting to see that in some markets. But we're not going to see appreciation halt, or we're not going to see a bubble where we're going to be back to where we were in 2008. It's just the numbers, and I'm a numbers girl, the statistics don't allow for that to happen.
We agree.
That tracks our analysis that we've talked about a few times on the show. And I think there are, I'm sure you would agree, a lot of other points that also point that direction, including the overall population trends, the inflation. I mean, we're seeing what appears to be a huge increase in housing prices, but in a way, we just have inflation metrics that aren't keeping up because things are happening quickly. So a lot of the change in valuation that we see may really be reflecting a decrease in the value of a dollar rather than an increase in the relative cost of housing compared to other goods. It's going to be interesting to see what happens.
Yep. So when we explain to the client how they can take the house they're living in now and keep that payment, but buy a much more expensive home, an upgraded home, they are blown away when we do that piece of the mortgage planning process, right? And it has to do with, that the inflation rate of the house has gone up. It's appreciated on both the one you're buying, the one you're selling, but interest rates are so low. It balances. So it keeps the market flowing.
Now, one of the factors that contributed to the severity of the prior crash was all of the ARMs that people had that reset from really low rates to rates that were perhaps not extravagant. It wasn't like 1980s level interest, but the resets pushed people out of an affordable payment range and into default territory. Do you see that as a trend that could recur over the next several years? Are people getting into very low interest ARMs that are going to reset later and push them out of their houses?
A few. The ARM market is not attractive to the mortgage-backed security market, which is what moves interest rates, and they buy and sell on the open market, whole different conversation. So it's just not really attractive. So there's not many ARMs going on. The majority of people are going into 30-year and 15-year fixed mortgages. So if they're, able to keep their job, if they're able to, manage their money, if there's not, an illness, something that happens along the lines that they couldn't afford the payment, there's not going to be that shock of the 2008, 2009 interest rates going up. I pick a pay, right? That was one of the things in, 2003 to 2005. Which one of these 4 mortgage options do I want to make? And one of them was a negative amortization, meaning that the balance was increasing. You weren't, paying anything towards the principal, but the interest was actually increasing. And people who got into those didn't understand that. They thought they were making at least the interest only part. And then all of a sudden, prices came down, their balance went up, and they didn't know what to do. And then it adjusted to this big payment that they had to make, and they couldn't afford it. That was one of them. And then, of course, what I love to call the ninja loans, the no income, no asset, no job. Those don't exist. Legally, we can't do those loans. So we have to make sure that the person can repay the loan. That's gone away. There's another factor that caused 2008 that just doesn't exist today.
Now, let me ask you something on that point. There are a number of companies that are offering investment property mortgages these days with no income, usually no verification of anything on the part of the borrower aside from the property's characteristics itself. They underwrite based only on the projected rental income. Is that something that you think could become a problem? Or is their underwriting process for those types of investment loans rigid enough that they're going to ensure that they've got security?
So the majority of those loans are being done by what we call in the market hard money lenders or private money lenders. They don't fall under federal regulations for underwriting guidelines. And so they come with really hefty down payments. They come with really hefty upfront fees. And that's how they ensure that if you don't make the payments, they're happy to foreclose on you. They also typically won't lend to owner occupied because it's much more difficult to foreclose on an owner occupied. So those loans are, they have a place in the market, but they are risky. And they, as an investor, you need to really understand what you're getting yourself into. And it's not the loan for the first time investor.
That's fair.
So what is it? You're talking about a family that, they bought their home in like Gilbert for $300,000. It's now worth $500,000. They don't want to go anywhere. They have all this equity. The obvious thing to do is to probably invest in other real estate. So how would you help a family in that situation?
Right. So, the mortgage planning piece is very specific. It's very personalized to each individual. But it is part of that whole financial house that we were talking about. And so we look and say, what are your goals? What are your needs? What are you doing? Most people are sitting on an immense amount of equity, right? And as Arizona has recently changed the Homestead Act, and which is being fought, it has left everyone open to a lot more lawsuits, because before people would look at the home and go, oh, there's not enough equity to sue them to get anything, right? And so now that equity has gone up, the Homestead Act is being changed on how much of your equity is actually protected on your owner-occupied home. It leaves people up to a lot of liability and risk. So I know that the paid off mortgage, people get really excited about that. And being from the Midwest originally, that's how I was raised: pay it off, pay it off, pay it off. But when money is so cheap and the opportunity to get sued right now is so high, why would you leave all your equity in your home? So one of the things we talk to people about is, can we pull that equity out and do something with it? Invest in other real estate. Use it to maybe, if you haven't funded your 401k, if you lived through that 2008, 2009 and got hurt, how do we make sure that you're going to be ready to retire? And I do have a lot of clients that are taking cash out of their primary home. Is protecting them from a lawsuit because it looks like they have no equity. It looks like they have no assets on paper, right? And then they're buying an investment property. And that one, with this market and what rents are doing, I don't know an investment property that isn't cash flowing. So not only are they taking care of all the expenses of that rental property, but now they have cash to make a decision to invest, maybe get their retirement back up. And that's all part of the bigger mortgage planning piece for sure. Now, interest rates on the investment homes are a little bit higher than they were 6 months ago, because the Fed stepped in with Fannie and Freddie and said you can only do 7.5% of all mortgages as a second home or an investment property. They were trying to slow down the real estate market. They were trying to open it up to the owner occupied. But the truth of the matter is, when we look at the rate of return, what that's done to interest rates, the 3/4 or the half to 3/8 that maybe it raised the rate, that doesn't stop an investor, because there's too much money to be made. And the thing with investing that I love when somebody really gets, when it clicks for them, is that house, somebody else is making your mortgage payment, right? So you've bought it with your, 20% down, right? So let's say you put $80,000 into a $400,000 rental property. Your $80,000 is being leveraged in multiple ways. The house is going to appreciate at what the house appreciates at, right? But it appreciates out of that $400,000 purchase, not your $80,000 investment. So the rate of return is crazy. And then you're not even paying for that investment, because your renters are making the payments, right? Your renters are making enough payments to take care of the taxes and the insurance and, and your income taxes, right? So when you really start looking at the rate of return for investment properties, even though quote unquote prices are up, it's a no-brainer when you really understand. And I love it when I see a client's eyes click, that they get, okay, I'm going to put in $80,000. I'm going to get a $400,000 investment that's going to appreciate, and somebody else is going to pay for. I mean, it's a great way to build wealth. And we know in this country, and when we look at the billionaires, what did they do? They built, like them or not, they built their wealth, most of them, on real estate. whether it was directly investing in real estate or it was a real estate REIT and investment, with backed with stocks and bonds of REITs. But the truth of the matter is that real estate is how we become rich in this country. Self-employed, hardworking, and real estate. Those are the three things that really build the wealth and the wealthy.
Absolutely. Your whole description there of the cash flow and returns on investment real estate was very succinct, and I think will help people understand how that goes together. It's a really interesting point that somebody else is making your mortgage payment. A lot of times people who are new to real estate investment will put together a spreadsheet or work with somebody else's spreadsheet to try to figure out the cash flow on an investment property, and they tend to focus on cash flow. And cash flow is not necessarily the right indicator to be looking at, because you can have an investment property with negative cash flow that is a great investment. You can have to pour cash into that property every month, and yet it can still be a fantastic investment because
and a nice tax write-off.
Yeah, exactly. The P in PITI is still your money. Whatever is getting paid on principal on your mortgage, you get to keep in the long run. So it makes it a little more complicated to figure out what your actual ROI is and figure out what matters more to you, whether you're accumulating wealth or whether you need the positive cash flow from your investment. But either way, you can make a lot of money at it. And like you mentioned, right now with interest rates the way they are, almost any investment property will have positive cash flow, especially. And
on top of that, rents have never gone down, right? So you're not like, oh my God, rents are going to go down next year. Rents have never gone down in the last 57 years that they've accumulated data on this. Rents don't go down, right? So it's another reason to become a homeowner if you're renting, because it's only going to go up, but we can stop, we can stop that bleed. But as an investor, you don't have to worry about, oh, is my rent going to go down? It's not. You're only going to make more and more each year.
Yep.
If you do it right. Some people, like when you're doing investment activity in real estate, it's really important to stay on top of it. A lot of people will just set it and forget it. And it's like, no, your property taxes are going to increase. Your homeowner's insurance are going to increase. You actually have to maintain the property. Sometimes your tenant is going to trash your house, and you're going to have to replace all the flooring and repaint interior, exterior. Things break like ACs and hot water heaters, and all of that is your responsibility. So it's really important that if you're going to buy real estate, you read a book on it. If you're going to buy investment property, talk to as many people as you can, because you don't want to invest all of this equity from your home that you have now and end up losing a bunch of money.
Talk to the right people. The water cooler talk and over the fence with the neighbor doesn't count. They're not the experts. Talk to the right people, yourself, myself, professionals who have been there, done that, and really understand it. But it's becoming a landlord is not for the faint of heart. But there's ways to negate that. I don't want a phone call at, 2:00 in the morning that somebody's toilet broke. So there's people to do that for me, right? That will take those phone calls. So you don't have to feel like you have to do it all, but you do need to go in with eyes wide open and know that there's more responsibility other than the PITI payment. And again, with rents being the way they are, you take that little extra, set it aside, you're going to be fine. Yep, for sure.
As long as you don't just spend it and then end up in a deferred maintenance trap where you can't afford to upgrade your house.
Right. Yes, that does happen. And the thing that we do with our clients is we have annual reviews, whether it's an owner occupied, a second home, or an investment property. We do annual reviews with our clients because life changes. And, like you said, you get swept up in it and you forget that things are going to change and, taxes will go up and that kind of thing. I don't know how many clients in the last year that when I finally had an opportunity to reach out to them, because we've been a little busy, were like, oh yeah, I've been meaning to call you. And I'm like, oh my gosh, you're at 5.5%. Like, what are you doing at that interest rate? Like they just, like you said, they said it and forgot it, right? So the fact that we're doing those annual calls, that's another way that we can help make sure that they don't, life goes fast and you get wrapped up in living your own life, and you do have to manage your investments.
So for you, when you're seeing new purchases versus refinances, which do you see more often right now?
I'm seeing more refinances in the sense that, I've been doing this a long time and I have a lot of repeat clients that call, right? Or that, again, we reach out to with the annual review and stuff. But the purchase market is still really strong. And, we're, I can't say it slowed down at all. Someone said to me, so I hear the market slowed down. How you doing? I went, slow down, really? I'm still working 6-7 days a week, 15, 18 hours a day. I don't know what you people are talking about. So it's still really strong. And again, for all those reasons that we mentioned, supply and demand. There were some clients, I think, that got burnt out with trying to, bid for that contract, right? And we changed the way we talk about it, right? They win the contract, right? And we're still having that. But those people that got burnt out, they're coming back into the market, and they're going to see homes coming back in the market. It's a whole nother segment on the iBuyer that we can, and the iSeller that we can talk about for sure. But about 10% of the houses right now are owned by some kind of I company. The hard part is, if you're a seller and you sell to them, the next day they put it back on the market for $40,000 or $50,000 over what you just sold it to them for. So please talk to a professional real estate agent like these two beautiful people on the screen and get a real number before you go that way. And I know sometimes they think it's about the convenience, but again, like the couple that I was talking about, we've got, before we got on the show, they have 3 kids and 2 dogs, and they really needed to get into the next house before they sold their house from 1986 that's had no upgrades, right? So they just had a lot going on. And it would have maybe been easy for them to go the iBuyer route, but with a true mortgage plan and a real estate professional able to show them what they could buy, they thought that they wouldn't be able to buy more than $600,000. They're able to go up to the $700,000 range, and they're able to do that before they even sell their current house. And they're going to be debt free, other than the house when we're done. I mean, the mortgage plan can get really in depth. So there's all sorts of ways to protect yourself, but that iBuyer, they're just going to put the market back on, $40,000, $50,000 that you just gave away, by going that route. But 10% of the market is in their ownership right now. So in the next few months, that's going to come back onto the market. So if you feel like you're a frustrated buyer, keep working with your agent, find a real professional agent, because there's inventory coming. It's still going to be a little bit of a bidding war, but maybe not as hard as it was 3-4 months ago when you got burnt out.
Yeah. A lot of people, that we're seeing and hearing online are saying things like, I'll just wait until the market crashes before I buy. And it's like, you can't do that. It's not going to crash. You're going to price yourself out. So some people are thinking, well, I know I want to buy this house. I'll just wait till it's $350 again. It's like, well, it might be $500 by the time you're ready to pull that trigger. So if you're kind of on the fence and you're in the Maricopa County area, there is no waiting. To wait and see if the market's going to crash. We're probably going to get way more expensive before we have any type of dip.
Right, exactly. And that's what I've been telling clients for this last year and a half. They're like, oh, I'm gonna wait till, the crash. I'm gonna wait till the market corrects itself. Okay, the market is going to correct itself, right? It's a natural, if you understand economics, it'll correct itself. But what is it going to correct from? So we're going to watch we've watched 1.5 years of appreciation. We're going to watch another 2, 3, 4 years of appreciation before it corrects itself. Will that correction just plateau out? Probably. Let's say worst case, that correction's 10%. Well, it's going to correct 10% from the appreciation 4 years from now, not from today's price. So either way, you wait, you're going to pay more for that house. Plain and simple. That's just what's going to happen. So I hear it too. And some clients get it when we explain, how long it's going to take. And when we explain, things we talked about, like the population growth and the fact of, really markets are moved by employment and unemployment. And, Arizona has 181,000 jobs open, right? So it's like everybody who wants a job is working. And so if you feel comfortable and content in your job, you're going to buy a house, you're going to refinance, you're going to do those things. And so, the price point of the markets are going to stay up. They're not going down.
A lot of people seem to look at the current housing prices in the valley and think they're completely insane, and it's understandable why people feel that way.
When
But
you've lived here for a long
yeah,
time, it does seem outrageous.
it does, but we're barely above the 2006 peak.
Correct.
If we're even above it, really, as you look at the market on the whole. And that was quite a while ago. I mean, that was well over a decade ago that prices were essentially the same as they are now. The expectation should be that now, 10 years later, prices are considerably higher than they were then. So it's really not unprecedented by any means. And in fact, I think there's an argument to be made that these are pretty reasonable prices, considering the population, our rank nationally as a major metro center, the time that's passed. These prices could hold indefinitely. If there's a correction, it could be a correction that levels off well above where we're at today.
Right. And that's what I anticipate.
Yeah.
We're talking 2-3 years from now, if we see that plateau, again, we've had appreciation this whole time, right? So the prices will be higher. And the nice spot that we're in right now, those people that want to wait, they're going to have higher interest rates. Plain and simple, interest rates are going to have to go up, right? And so if you buy now, you're going to lock in at that 30, 15 year, 20, 25 year, whatever we end up deciding is right for the mortgage plan, but we lock that fixed rate in the 2s and the 3s. It maybe, depends on how fast you move, right? And interest rates go up, but the prices are going to keep going up. The rates are going to go up. So the affordability that you were talking about, which you were alluding to for, 2006, when we look at where the interest rates are, the payment is the same or less than it was in 2006.
Yeah.
So, hop on it now before rates go up, and rates will go up. I mean, the good, bad, and the ugly of what I call the talking heads, most of them are wrong most of the time. But they're all saying the same thing. Even the ones that I like and appreciate and respect, interest rates are going to go up. And again, it's supply and demand, it's economy. They have to go up, right? If they don't go up, they can never come back down.
Yes, indeed. So we talk a fair bit on this show about all the nuances of investment purchases of real estate. And one thing that's come up a few times is the question of when to buy for investment purposes. And a lot of people are not acquiring for investment right now. A lot of people who were buying many investment properties a few years ago are not really looking at this as a favorable market to buy. What are your thoughts on the question of whether people should be buying for investment purposes right now, or maybe holding off a little bit?
Yeah, the best time to buy an investment property was yesterday. The second best time is today, right?
Yep.
It's plain and simple. I mean, it really is, because of everything that we've been talking about. Prices are going up, rates will go up, and you can start your investing now. I mean, if let's say we weren't talking real estate, we were just talking the market. A financial planner is going to tell you the same thing. When is the best time to invest? Yesterday. When's the second best time? Today, right? No matter what's going on with the market, it's about a strategy. And investing is long haul in most of the time. I mean, I have a few buyers, investors that will be like, okay, I'm gonna buy for a year, get to my 1 year capital gains and get out, right? Like, they like that turnover. But in general, real estate is purchased for the long haul. And so it becomes part of the mortgage plan. It becomes part of the financial plan. So now, right? Because for all the same reasons, prices and rates are going up and rents are going up. Why not get in now and next year get more rent? So yeah, the big thing with the investing is people don't understand the nuances of the mortgage. And it is very different than your owner occupied mortgage, right? And so sitting down early and doing a mortgage plan, getting a pre-qualification, even if you're thinking, I don't want to buy till next year, I'm busy, or I need to save the money, or whatever the plan is, sitting down earlier rather than later. I'm shocked at how many people that think, oh, I'm not going to buy till next year because of X, Y, or Z. And when we sit down and we put the plan together, and I put the plan together, like, if you want to buy now, you can do this. If you want to buy next year, this is what it'll look like. And most of them like, I had no idea I could buy now. I read X's book or I listened to Y on TV and they told me I needed this and this to get in place. And that's not the case. A lot of people can buy now. And if you can't, next year is better than the following year. So start the planning soon and early. Know what you can do when you can do it. And then it's up to you to pull the trigger to make those decisions.
Amen.
Absolutely. Well, we're down to our last 30 seconds here. What's the final advice that you would have on the mortgage front for people who are looking to expand their real estate or start investing when they haven't done it before?
The mortgage plan. You have to work with someone who understands true mortgage planning. You can walk into any bank and get a loan, right? You can walk in to any mortgage broker and they're happy to try to figure something out for you, right? But you need a true mortgage plan. And that mortgage plan is, not only working with someone like myself, a certified mortgage planning specialist, but making sure that I bring in all the pieces. Do you have a good CPA? Are you working with professional real estate agents like this, two of you? Who is your team? When you invest in real estate, you should have a team. As much as if you invest in the market, right? You might like to go to Robinhood and invest yourself, but if you really want to build wealth, you need a financial planner. You need a team. You need a CPA. So you need the same thing there. And if they start with me, I'm the only one in the financial picture that has every piece of your information. So you might leave something out accidentally with your financial planner, but you can't leave anything out accidentally with me. So we set you up for success before you ever get your heart set on a property or a cash flow or a plan. Yep.
Excellent.
So plan. Plan ahead with Juli J.
Yes. Well, that has been Lawgitimate for today. Thank you all for watching, and thank you, Juli, for coming. Again, Juli Doyle with Fairway Independent Mortgage. Get in touch with her for sure if you're interested in expanding into investment real estate, or even if you're just going to be switching houses or thinking about it. As she said, it's better to get in touch with someone like her early. That way you know what your options are and you have the process under control. Thanks a lot. This has been Lawgitimate, Mike and Rochelle Poulton, and enjoy your week.
Talk
Thank
to you
you.
next time.